markets, though, seem pretty confident that we will continue to see those rate cuts. This GTV chart on the Bloomberg showing that after those new tariffs last week, market now pricing in another 25 basis point rate cut in September. Given all of the uncertainty, what are investors going to do? Will we continue to see the shift into more liquid assets?
I think that is the case, because this latest development, this was the real tail risk hanging over the market rally, if you think about it that way. I mean, this remaining balance of 300 billion, that is, if everybody agrees on that, that could be really impacting the US economy, that seemed to have so far been, quote unquote, insulated from the weakness that we've seen in the global economy. So if the US economy does start to shift down further, then that is the real change that we're going to face with, and then that will drive investors more conservative into liquid assets, say treasuries or gold or etc., until there's a resolution. And now we're learning that this resolution has become very upended, in the sense that it takes a lot of time to actually get to this real deal, even though there may be agricultural purchases happening in between. I think investors face a very uncertain period, so therefore conservative stance.
Well, we've talked about the Fed, we've talked about trade, but of course another big piece of the puzzle is earnings. How do you see earnings season playing into this so far? It hasn't been great, but then again, expectations weren't terribly high either, were they?
They were not high, Paul, and I think that was sort of the year-on-year fact that after the tax reform last year, in the third quarter, markets had the sense that earnings would really slow down this year. That said, though, there have been some surprises this quarter, though, that there have been various of companies reporting far more better earnings than people thought. But I think going forward from here, the big question remains is how the global economy fares after this latest development, because if they've all factored in that earnings could rebound next year based upon a natural rebound of the global economy, there's going to be adjustments to that. So I think this week particularly that this new information will probably be digested in earnings calls. I think that's what investors will watch for, like, are you factoring this already in, or are we going to stay in sort of a situation where you expect eventually a rebound in earnings, and therefore investors will continue to extrapolate that out in the equity markets, potentially seeing higher returns in the future.
Yeah, you mentioned getting into more liquid assets before. In terms of getting into potentially the equity markets, we were hearing from Warren Buffett over the weekend. He's sitting on a huge pile of cash, 122 billion, saying he doesn't like the valuations in equities at the moment. Do you see any value there?
Well, there's always value, Paul, I think. I mean, that has a lot to do with the fact that you have, earnings that are, solid in the terms of, like you said, companies have been really cushioned against downturns because of highly liquid balance sheets. And so far, the leverage that corporate balance sheets have built up has not really been unwound. The capital markets are still wide open and companies can access capital. So I think that's not the issue. But this example that you mentioned from a major investor like Warren Buffett, who has been on, by the way, in this liquid position for quite some time, is a reflection of just simply an uncertainty that people continue to see hanging over the global economy. Because if you really think about it, we're back actually where we were 3 years ago. We're again dealing with a very sluggish global environment. We're dealing with uncertainty that is hard to calculate, say the Brexit and now the trade war. And then we're dealing with a low inflation environment too. And I think this is where investors will look at, like, margins and pricing power for companies will be very driven by the prospect of future inflation. And that seems to be very, very muted at this point.